Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me to discuss the sustainability of the market recovery is Brian Levitt, global market strategist at Invesco. Brian, it's great to have you with us. Welcome to Trade Talks.
Thank you. It's nice to be back.
All right, Brian. So what drove the market retracement, and are you surprised by the V-shaped recovery in stocks?
I'm not surprised. I mean, I thought maybe we would have retested some of the lower levels. I'm surprised at how consistent the advance has been, but I'm not surprised to see markets retracing higher. We've had a very massive policy response. We're seeing some improvements in economic activity. You're seeing in parts of the world that are able to compress cases a resumption in economic activity. And you're really seeing the market being driven by those types of businesses who are able to generate growth in this type of an environment. So while there does feel like a disconnect to the broad economy, massive policy support and those businesses that can lead in this environment are doing so.
All right, and Brian, of course, we know what the tailwinds are. What are some of the headwinds that you're watching? And with that, with the bullish and bearish case presented, which one are you more compelled about?
So I'm more compelled with the bull case. I believe that what ultimately emerges from this is a very slow growth environment, similar to what we saw out of the '08 financial crisis, a prolonged period until we get back to full employment. And what that means is policy supportive almost indefinitely. And so in that type of an environment where borrowing costs are going to be very low for most businesses, I want to own equities. I think we're setting it up for the next long cycle in equities. Are there some near-term headwinds for markets? Sure. I mean, you could probably always articulate near-term headwinds for markets. They seem a little bit overbought in the near term. There is some possibility that mobility in this country slows down a bit or is starting to plateau now that cases are elevated in certain parts of the country. And we still have policy risks with regards to fiscal policy. We've got the uncertainty of a presidential election. So there could be some near-term volatility in markets. But what's most important, I believe, a new cycle has emerged, and that new cycle is going to be a long one and should be good for credit markets and for equity markets.
And from a sector and industry perspective, are you starting to see hints of cyclicality?
You are starting to see some hints of cyclicality, and you're starting to see things like copper and industrials and materials and parts of the market that do better in a weaker dollar environment, starting to participate in some of the performance. And I think we'll continue to see a broadening out over time. Cyclicals and as the economy starts to gain a little bit more traction, maybe the deeper value parts of the market outperforming. But over time, I think we're going to be in a slow growth world. And I think that slow growth world is going to favor the more growth oriented cyclical parts of the market. And so, yeah, we're seeing some broadening out, which is a good sign. But I don't think that leadership changes meaningfully to the deeper value parts of the market. I think we continue to be led by those companies that are disrupting and are on the cutting edge of the changes in the secular economy that are happening.
Let's spend some more time on the U.S. dollar. And this is a consequence of the massive fiscal stimulus, uncertainty with politics, social issues, COVID-19. That's really what's impacting the dollar, because typically a lower dollar would be good for U.S. stocks. But this move might not necessarily be for the good reasons.
Well, we had a very prolonged period of dollar strength, and we would continue to strengthen the dollar, whether it was 2015 or 2018, with what I would deem were policy mistakes, premature rate hikes by the Federal Reserve. And so, I view some stabilizing or weakness in the dollar as a good sign, suggesting that policy is going to be accommodative for a long time and suggesting that money can start to flow to other parts of the world that are the beneficiaries of improving economic activity coming out of a better ability to compress cases of COVID. Now, that doesn't mean that the dollar collapses. I would be far more concerned right now if the dollar was strengthening meaningfully as sort of a risk-off asset. So a weakening of the dollar, I view that as favorably. Some inflation expectations starting to pick up. That doesn't preclude U.S. equities from performing well. It suggests to investors that after 11 years, they can start to think about non-dollar assets where valuations perhaps are more interesting. And there's some good growth stories taking place over there as well.
Yeah, Brian, and that's exactly what I wanted to wrap up with. What are you watching in international and emerging markets?
Yeah, obviously you're looking for signs that this resumption in economic activity overseas can continue. Good news out of China continues, particularly in the manufacturing sector. You're starting to see some signs in Europe of economic activity picking up, and obviously more of a coordinated fiscal policy response. And all of that value that exists over there, you needed a catalyst to unlock it. And some of that catalyst now becomes the emergence of these economies out of the recession, interest rate differentials that are not all that different than the United States anymore, and a weakening of the currency. So for 11 years, US investors have been disappointed investing overseas. These types of catalysts can now serve as tailwinds for US investors looking for great growth companies, which are difficult to find. They exist in many parts of the world, and they're trading at more reasonable valuations than they are in the United States.
All right, Brian, great to have you with us. Thanks for joining me on Trade Talks.
Thank you.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.